Welcome back, everybody, and we're just about to jump into session 2, part 2 of the video series. If you haven't listened to part 1, I highly suggest you jump in and take a look at that first. In this session, we're going to continue on with the core statements, starting with the income statement and then working our way through the cash flow. So let's go ahead and jump into the income statement. So now we have the income statement, and if you're following along at home with the template, you'll see the income statement tab and you'll see income statement here. However, if you happen to scroll down, you'll also see this statement of members capital. We'll go over that here in just a second, but I just want to let you know there is a reason why this is sitting here on the income statement. So back at the top, let's look at the very top. Remember what we said about the difference between the balance sheet and the income statement on the date aspect. The balance sheet is a point in time. The income statement is a period in time. And in this case, as you can see, it says for the year ending December 31st, 2018 and 2017. So what that tells the user of these financials is this amount in this 18 column, this amount in this 17 column is for 12 full months. The beauty of an income statement is you can do an income statement just for a month. You can do it for 2 months, 3 months, a full year. Sometimes you can even do 18 months if you wanted to. But just keep that in mind when you're looking at your income statement, is what time frame am I looking at here? And so the date should always indicate for the period ending. Sometimes you'll see for the 6 months ended, 3 months ended, for the quarter ended, what have you, but it somehow needs to indicate what time frame you're looking at when you're looking at these respective financials. So obviously the first thing you see on the income statement is going to be your sales or your revenue. And that's going to be pretty straightforward, and again, this is on an accrual basis. So even though you might not have received the cash on that, last couple sales in December of 2017 and 2018, it's still revenue in those respective years because you earned that revenue. And so that's why that's going to be there. Now the next item is less discounts. Now this is traditional accounting, is if you have any sales discounts, you show it separate from sales. I'm on the thought process that if it's not even material, don't go to the trouble of trying to break it out. If, for instance, this sales discount, let's just say it's just 14 bucks. $14 is not going to change the user or the financials opinion on that. So keep that in mind on the discounts. A good thing about having the discounts is if you do offer a lot of sales discounts, you'll have it broken out here and you'll be able to see trends on your financials. But again, if it's not a material item and you maybe do 10, 20 bucks a year, you don't break it out. It's just come up into your sales. Instead of saying sales, say sales, comma, net. And that just tells the user it's net of discounts. So we get our net sales, and then, like I've harped on before, is one of these biggest items on your income statement, your cost of goods sold. Again, this is something you have to fully understand, all the costs that are going in there and how it's made up, and are those costs accurate? Because we come down and we get to our net profit, and the net profit is a driving force on how you're going to be doing your break-even calculation. So it has a big effect on that. So again, we're going to go over that more in Module 3, but like I said, the cost of goods sold or your cost of sales, depending on how your software is set up, is a very, very important number. Then you come down here into your operating expenses. Now, with your operating expenses, you want to break out the bigger chunk items. And this one, like I said, this is I just threw this together so we could see how the information flows. But 90% of the time, your labor, your wages, however you're going to label it, that's going to be your biggest expense. And if you're just starting out, your next biggest expense is probably going to be rent, whether it's rent of a building, rent of equipment, what have you. And then you have all your other expenses. You really want to have a breakout of what are some of the operating expenses that truly are drivers for your sales, but don't fall into the category of cost of goods sold. The reason being is you'll end up doing what's called a vertical analysis, and that'll help you manage your expenses and manage your business even better. Ultimately, where we're going to get to is we're going to start showing you what are the levers in your business? If I pull one lever, if I pull back on labor, how does that affect my sales? If I pull another lever on my selling expenses, how's that going to affect my sales? And so understanding the ratio of the expenses to your sales and how they interact is very key. And so that's why we want to break out the bigger items here, so that helps you, the user, understand that. Another thing to consider is some industries have set parameters on how the financials need to look. It's just how the industry has always done it. You may be in that type of industry and you may have to combine some of these items together for external purposes. Internal purposes, have them set up on the best way for you to be able to analyze your financials quickly and efficiently. Again, we need to have them set up in a way that makes it easier for us to be able to analyze it, because we want to be able to pull those levers to get your company where it wants to be. Again, with your business, you need to have it set up so that 5 years from now I want to sell it for $5 million. Well, how do I get to that point? What levers do I need to pull on my income statement to get my company in that direction? So again, that's very important. Then administrative, these are kind of your back office people, the back office stuff. Again, I didn't put much in here because if you're a startup or small business, you probably do most of the administrative stuff and don't really have anybody set up to do that. But again, you want to have that admin type expenses broken out in a separate category. Again, these are the back office stuff. They're not necessarily going to affect the sales. These, your operating expenses, will affect your sales, will affect your revenue. So that's why you want to have those broken out. Then you come down to total expenses, add them up. And then this other area, these other income expenses. Now, these are going to be your miscellaneous expenses that don't really fall into these categories. And the reason why you want to put it in this other income expenses is you don't want to skew your analysis on your expenses as it's compared to your revenue. In other words, what's driving your revenue? If it's just some weird miscellaneous expense that you normally don't ever have, let's just say it was a parking ticket or something odd like that, then have it in the miscellaneous area so it doesn't mess up your analysis. And then of course, interest income. This is not revenue. You're not in the business of investing funds and getting income from that. If you are, then obviously interest income would be up here because that would be part of your operations. But in this case, no, it shouldn't be. It should be down here in this other income expenses. And then of course, we come down to that magical number, your net income. And again, when we get to the cash flow, we'll go through this process and we'll see how that interacts with your cash. But then we get to your net income. And when we go over more of these items, you really want your net income to be about 10% of your sales. And I'll go over that more in Module 3, but that's really kind of what we're starting to see as the quote break-even point for your company. It's not the true break-even of revenues cover expenses. This is more of what's the financial health break-even of a company. So now we come down to the statement of members' capital. So if you've ever had audited financial statements, you probably have seen a title up here that says income statement and members' capital, or income statement and statement of retained earnings. The reason being is because income, recall when you close out your financials, you close out the net income to the equity. Because they're so intertwined, it's a lot of times you will see this statement as part of this statement. Normally you wouldn't see this header put here. This would be up here, and then the statement of members' capital would be up here, just combined up there. I broke them out so you can see a clear break in between those two statements. So statement of members' capital, just like it says, what's your capital contributions into the company? What was your net income? In this case, this is last year's net income. So in this situation, I said this company started up sometime in 2017 and the partners contributed $6,000 to the company to get it started up. And then that first year of business, they had net income of $1,665, come up with ending equity balance of $7,665. Then in 2018, I just put the assumption that there was no capital calls. There wasn't additional contributions, there weren't any distributions. It just was the plain, simple, easy net income. That's it. So then you have net income for the current year comes in here, and then this gets added to that, to the ending balance of the equity, to come up with your ending balance as of 2018. So why is this important? Come back over here to our balance sheet, and we scroll down, and let me zoom this in so we can see it. Come over here, look at that number. Does that number look familiar? 37,565, 37,565, 7,665, 7,665. So if you happen to be looking at this template in Excel, if you're using Excel, you'll see this formula up here, income statement. So that's what this is saying, is this coming straight from the income statement right here. So that's the beauty about all this. And again, like I said, with all these tabs, these are all interrelated, or interconnected, I should say. And what's happening on here is it's allowing you to see, if I change a number, how does this affect these financials? And in the next session, we're going to go through the receipts and disbursement process, and we'll walk through a transaction, how it flows through. But real quickly, I just want to delete a number real quick. Let's just say this number disappeared. And so our equity changed. But now our balance sheet's out of balance. Well, why is that? Well, if you think about it, if I came in here and I got rid of this number, and I'm going to put it back there, but if I got rid of that number, that's technically getting rid of one side of a journal entry. If, think back to when we went over the scale concept. If I got rid of this number, and here's my net income, it's flowing through, but all of a sudden my balance sheet doesn't balance. Well, that's because when this entry was initially put into the financials, there was a corresponding credit, because this is an expense, so this is going to be a debit. So there's a credit sitting somewhere else. So that's what I wanted to show you on how these statements interrelate with one another. Now, you probably don't have the override capabilities in your accounting software, in your, whether it's QuickBooks, Xero, FreshBooks, what have you. But I just wanted so you can see, and this is kind of another part of the scale concept, is if in this instance, if somebody had posted this entry, and let's just say this was a payable. Let's say the other side was the credit on this entry was AP, and the debit is the expense. So let's say you happen to just post that one side of that journal entry. As you see, it messes up the balance sheet. And so, and actually will mess up the cash flow statement. You'll see right there, it messed up the cash flow statement as well. So that's what I wanted to kind of show you on that. But again, this equity section is important, and this is, when we talked about tying out your equity, this is where it's going to get tied out on your financials. Now, let's say you are now in 2019 and you're rocking and rolling. This number right here, that'll be your beginning balance on your equity. Now keep in mind, this is a sample company. This number is not what's going to be on your financials. But on sample company, let's say they're in 2019, this is going to be the beginning balance. So right here, this number will go up there, and then whatever their net income, whatever it is going to flow through there. If I go into a sample company and somebody happened to post date a journal entry, i.e. they got an invoice in 2019, it had an 18 date, and they decided to post it as of 18, but we've already gone through this process, we've already closed everything, their equity on their books is no longer going to match this equity. So that's why it's important that we have it reconciled and we understand how the information is flowing through. So now cash flow. Remember how I said this is the most important financial of all of them. This financial is, like I said, it's the most valuable, and I'll be honest, it's one of the most difficult ones to put together. But once you understand how everything flows through, you are going to be your eyes are going to open, and it's going to make life so much easier from an analysis standpoint. So when you do the cash flow statement, now this is called an indirect cash flow statement. And what that means is, here's net income. We analyze and get rid of all the stuff that's in net income to get to cash from operations. Now, there's a direct cash flow method, and what the direct cash flow method does is they say, what's the cash receipt from customers, what's the cash disbursement to suppliers, and then gets to the cash from operations. I prefer you get to understand the indirect. The reason being is, let's come back over here. Our income statement says we have net income of $29,900. Oh, sounds pretty good. Kind of like that. I'm going to our cash flow statement. Here's our net income. But look at cash from operations. That number is not equal to that. It's actually bigger. And that's why I want you to be able to understand how this works, is because when you stare at your net income, and you look at your balance sheet, you want to be able to say, okay, yeah, I got $29,000 in net income, but how much cash do I really have? And so that's what you want to be able to look at in this process. So here is change in operating assets. So the first part in the indirect is you take out the non-cash items. Now, a non-cash item is usually going to be some sort of adjustment for estimates or depreciation expense. So anything that's an estimate, that's, it's literally, think of it, it was just a quote accounting entry. No cash came in or out. I just posted this entry to my financials and I hit the operating stuff within my company. That's what a non-cash entry is going to be. So in this case, depreciation expense is going to be a non-cash. Again, remember, depreciation is we're allocating the cost of that asset that you purchased, this year or the year before, or even years before, to the income statement. And so, but it has no cash effect. So here's this non-cash, and keep in mind we're adding it back because it was an expense and it reduced your net income. So now we're going to go and we're going to add it back for our cash flow analysis. Then we go through this change in operating assets and liabilities. What that is your accounts receivable go up and down every year. Your prepaids, your other assets, your AP go up and down. And the change in that has an effect on your cash. So if you think about it, let's say your accounts receivable last year was 0. You didn't have any accounts receivable. And then this year you have accounts receivable of $2,000. Well, let's think about when you have accounts receivable. To put accounts receivable on the book, you increase revenue, $2,000. You increase accounts receivable, $2,000. However, did you get any cash? You probably didn't. And so even though your net income may be going up, you didn't get any cash. And so that's why we take the change in those accounts instead of backing out the effect of last year and adding back the effect of this year. We just say, what's the change in these balance sheet accounts? And we're going to go through this cash flow worksheet in just a second. So don't, as I'm going through this, if you're starting to get kind of lost in it, just bear with me. We'll go through the worksheet and it will make a lot more sense. But what this cash flow statement does is it gets through all those change items that have an effect on the income statement or on the cash flow that didn't really have any cash in or out based on the change. So we come down to cash from operations. Cash from operations, as I mentioned, is one of the most important numbers within your financial statements. This tells you, what they're saying is, in this particular sample company, they made more cash than they had expenses for, operating expenses. So they're funding their operations with how they're working. So my question to you is, do you know in your business, are you funding your operations? Now, I'm going to assume that you're not a first year. If you're a first year, don't get too worked up on this cash from operation because your first year is you're building up everything. But if you're in year 3, 4, are you funding your operations? Is your cash from operations positive? Or is it just barely break even? Is it like just a couple $100? And so that's where you want to look at, is where are you at in this? Because if you have a negative, that's when we need to take a step back and look at, are you selling your product for enough money? Or do you have too much expense in there? Are you paying too much on employees? Are you paying too much on rent? You need to downsize, what have you. This area, if it's negative, that's when we have to take action. You need to take action right away or fully understand, okay, maybe this is just a blip and next year you're going to get that huge contract and everything's going to rock and roll and we'll be happy. Great. But this is going to help tell you really where are you at in your business. Now, cash flow from investing. This is just like the title says investing. So investing is going to be either investments such as mutual funds, certain CDs, bonds, what have you, just standard investments. And also this includes fixed assets. So any cash you sent in or out to purchase these items fall in here. Most of you, it's going to be fixed assets. Either a vehicle or a piece of equipment, or even leasehold improvements. You're leasing a building, but you need to add room to the building for production or what have you. That's where this information is going to go. And that's, like I said, that's the beauty of this, is the cash flow doesn't bring this into your operations. It's just saying, okay, what did you do above and beyond your operations from cash flow? So in this case, purchased an asset for $15,000. And then we get to financing. Again, just like the name says, financing, that's going to be your mortgages, that's going to be your notes payable, any kind of debt. If you have a line of credit, so the standard, the accounting standards say you have one line item for any cash draws, i.e. loan money that you got, and then you have another line item for cash payment on your debt. Well, if you got a line of credit, just net the change. Don't try to kill yourself, because if most businesses, you pull on a line of credit in January and then you pay it off in February, and then you pull on it again in March, and back and forth and back and forth and back and forth, and just do the net. It's really, nobody's going to get too worked up on that particular nuance. But payment on notes payable. Now, this payment, that is strictly the principal payment. There's no interest in it. Remember, interest expense is an expense, and it's up here already in your net income. So when you pay down your loan, or you make your payments, in this case it happens to be an even amount, but it's probably not going to be an even amount because of interest effect. So that's just going to be the amount that reduced the principal on your debt. And so then the other item that comes in here is if you have any capital contributions. So you do a capital call, you and your partner say, hey, we need to put money in the company, this is where you're going to put it. And then also if you pay distributions, so you've worked hard and, hey, I'm going to take a distribution out of this company, this is where you're going to put it, is in this area. I didn't put it here just because I wanted to try to keep it as simple as possible, but just keep in mind that's where this will go. And then we come down to our change in cash, add it to beginning cash, and then we get our ending cash. So come back over here, we look up 36, there's our cash balance, 36,665. Come down here, there it is, bang. Again, if somebody happens to mess up something, and I'm just going to do this real quick just so you can see this. Right now I've got a conditional formatting here that says if the balance on the balance sheet doesn't equal this, then something's wrong. So if you come to the balance sheet, this balance sheet still works. But that's because I only changed something in the cash flow statement, so that then it says, hey, your cash flow statement's out of whack, something's wrong here. So just wanted to let you see that. So now let's go into the cash flow worksheet. So this is the cash flow worksheet. Now I know if you've clicked on this, you're staring at this and your mind's probably blown and like, what have I gotten myself into? This is just so I could show you how we get to these calculations on this information. Now, I don't expect you to be able to go through and put this together and tie this out and all that. I just wanted you to see this so you have a better understanding on how the balance sheet affects your cash flow statement and how the income statement affects your cash flow statement. So that's why we're here. I'm going to walk through this. Like I said, I don't expect you to do this. I just wanted you to be able to visually see how it affects, and so you can see kind of how this worksheet flows through. So the way this worksheet's set up is all the balance sheet accounts are linked in here. So as you can see, balance sheet, it's all coming from the balance sheet. And these are beginning balances and ending balance. So on your cash flow, remember when we were briefly talking about the change in operating assets or operating accounts, this is taking that change. So here's accounts receivable, had a change to 2,000, prepaid 3,000, fixed assets 6,000, and this is taking all your balance sheet accounts. And over here is the totals. So if you do decide to go ahead and put this together and go through it, hey, I great. Obviously expanding your knowledge is always a great thing. But if you're doing that, make sure these totals equal 0. So what that means is all your liability and equity accounts, you need to put them in as credit balances. And so that's what these brackets are showing, is these are credit balances. Because if you don't, so in other words, if I change this to a positive, it's not going to foot to 0, and then it'll cause a bunch of issues. So just keep that in mind if you are going to decide to go ahead and do this on your own business. Just keep that in mind. So here we go through and we calculate the change in each one of these balance sheet accounts. And these are the major accounts. Again, this comes from the balance sheet itself, not from the GL, because the GL may have like 10 AR accounts and 4 other asset accounts. This is just taking the totals from the actual balance sheet. So first item is members capital. Remember how we tied out equity? Here we had our beginning equity, net income, ending equity. What this does is says, okay, here's this change in this account, and we need to be able to reconcile this difference. So the way this worksheet works is, you see down here, there's all these items here. If I had, I'm just going to put a big number here. So what you want to do is you want to be able to reconcile here and put in whatever the change is made up of this, and so this balance down here will equal 0. And that's how this respective worksheet is going to work on that. So in this situation, here's the change in members capital. Well, I know my net income is going to be $29,900. We know that from the income statement. But let's say that there was a distribution that happened, and so this balance really isn't $29,900. Let's say there was a distribution of $3,000. What this would do is this would show a total difference in here of 3,000, and so you got 26, and actually this should be coming from here. So now we've got a $3,000 difference, and so now we're like, okay, I can reconcile 29, but now it's still 3,000 off. Why am I 3,000 off? That's the beauty of this, is we can bring in what we know it should be, and any difference would help us go back and say, okay, something's not quite right. Again, this is where a cash flow statement starts to get a little bit on the complicated side. So then we come over, next item, fixed assets. Well, our fixed assets has the net change of $6,000. Well, we know we have depreciation, took it right from the income statement, of $9,000. Remember, depreciation is a non-cash, so you always add it back because it's reducing your net income. So we bring in the $9,000, and so we've reconciled part of that, but we're actually going the wrong way over symbol. So what's the difference? Well, we happen to know in this situation that there was $15,000 of an asset purchased. So we say, oh, yep, got to put that in there. Bang, that drops in there. So now we come down to the actual changes. So the rest of these are going to be the items that are affecting your change of operations. So first, AR, it's pretty simple. You see, okay, AR changed by 2,000. That means I have a negative 2,000 here. It's going to be the opposite of these symbols, because we want these numbers to net out to 0 down here. So brings in that 2,000. So again, if you think about this, if my beginning balance in AR was 13,000 and my ending balance is 15,000, that means I had $2,000 of sales that I haven't collected that are above and beyond last year. Or another way to think about it is, if I had 0 AR last year and I got 2,000 AR this year, there's 2,000 in net income, or 2,000 in sales that I'm showing that I didn't collect cash on. So what this does is it takes it and says, okay, your accounts receivable went up, and so technically your cash didn't go up with that sale, and so we're going to back that out. And so that's how that flows through. Prepaid, same concept. Last year we had 0 prepaids. This year we have 3,000. So we paid money of $3,000 for the prepaid, but we haven't sent it to expense. In other words, it hasn't affected our net income yet because it's an expense that we capitalize and we haven't sent to the income statement yet, but we paid the cash out. So that's going to be an adjustment. And other assets, same concept. Accounts payable. Now this is going to always remember, accounts payable change is going to be the opposite of your accounts receivable change. And that's going to help you as you go down the road. Is if accounts receivable goes up, that means you had sales, but you didn't get the cash yet, so your cash didn't go up. Now accounts payable, if accounts payable goes up, that means you have an expense, but you haven't paid it out yet, and so you technically kept cash, because you got that equipment, or you have that expense, but you haven't had to pay the cash out yet, and so that's why it's going to be flip and be the opposite. So that's going to be your change your AP, accrued liabilities, the exact same thing. So I know this is going to sound confusing, and a lot of you probably glazed over halfway through this, but I just want you to see how this flows through and how we get to this 37,300. So I encourage you, go through and play with this. If you want, go and change the accounts receivable balance over here. Now remember, if you change a number here, you got to change a number somewhere else. So you can change this, reduce this number and increase another asset number or what have you. So just go ahead and, if you want to, play with that and see how it flows through. But remember, I've got these conditional formatting in the balance sheet to keep, if it is out of balance, to be able to say, oh, whoops, that didn't work, so let me make sure my balance sheet still works. And then you can come in here and look at it. And a lot of these, you'll notice, are just a formula. So this is literally just taking the opposite of that change. This is just taking the opposite of that change. So outside of the fixed assets and the long-term debt, all these items are just taking formulas, so they should change automatically for you. So again, these all foot to zero as we go through this process, and then this comes through onto your cash flow statement. So I know that was a lot to throw at you, but I wanted you to be able to just hear it and be able to visually see it at least once. Again, if you get down the road in a month, 2 months from now, please go back in and just watch this part real quick. And as you go through a cash flow statement, the first 1, 2, 3 times you put it together, you're going to get frustrated. It's going to, just not make sense right away. But the more you plug away at this, the more you'll understand. And the more you understand this statement, the faster you'll be in analyzing your information and fully understanding. Because there's a saying in accounting that I, as an accountant, I can make you, the business owner, as profitable as you want to be. However, is it going to be A, legitimate, or B, is there going to be any cash that comes in? So that's one of the keys. So upcoming in the next session, we're going to go through the cash receipts and cash disbursement process. And what we'll do is we're going to use this same template, and we're going to start saying, okay, how does a transaction affect the balance sheet? How does it affect the income statement, and how does it affect the cash flow? Because remember, all these statements are interlinked, and so we're going to go through it and see how those transactions affect it. First, we'll help you understand the processes, but then we're going to see how everything flows through. So with that, I thank you for your time, and I look forward to seeing you again in the next session. Thank you.